Something has shifted over the past 24 months. Without a single breaking news alert, without a senator standing up to speak about it, and without a word of caution reaching the American public, the rules surrounding the $10,000 bank reporting law have been revised 5 separate times. And every one of those revisions makes it harder, riskier, and more costly for you, the ordinary American retiree, to move your own money. This is not a warning about something that is coming. This is a warning about something that has already happened. It is happening right now. It is happening this week. It is happening in bank branches across all 50 states, and almost nobody over the age of 60 has been told any of it. I am going to show you 5 specific changes that have been quietly rolled out between 2024 and 2026. Change number 1 can now pause your withdrawal for a full 72 hours before you ever see a single dollar of your own money. Even if you are mentally sharp, even if you have banked there for 40 years, even if you are buying a car you have been saving for since your 60th birthday. Change number 2 can turn a series of perfectly legal $9,000 deposits into a federal felony carrying up to 5 years in prison. And the pattern detection software that flags you just got upgraded this year to catch patterns that never triggered before. Change number 3 pulls every crypto transaction. Every Zelle transfer, every Venmo payment, and every Cash App send you make into the exact same federal reporting pipeline that used to only catch suitcases full of cash at the Mexican border. And the reporting threshold on those digital payments drops to $600 this year. Change number 4 doubled the penalties on a form that your handyman, your contractor, your lawyer, your car dealer, and almost every business you spend real money with is now required to file about you. And change number 5 is the most shocking of all because it is not a change at all. It is a number that has been frozen in place since the year 1970. And it is the single reason that everything else in this video has gotten so dangerous so fast. My name is Ivy. I am an enrolled agent with over 20 years of experience representing taxpayers in front of the Internal Revenue Service. And what I am about to show you today is not tax planning, it is survival planning. Because the $10,000 bank rule that most Americans learned about decades ago is not the rule that exists today. And if you try to move money the way your parents moved money in 1970, you will get flagged, frozen, reported, and in some cases have your money seized even though you have done absolutely nothing wrong. In the next 25 minutes, I am going to walk you through exactly what has changed, who it affects, what the average retiree is doing right now without realizing it. That is tripping every single one of these new rules, and most importantly, the 5 protection moves that you can use this week to make sure your money moves the way you want it to move, not the way the government wants to track it. But before I get to the 5 changes, I have to tell you the story of Martin and Carol, because their story is the best possible example of how fast this can happen to a couple that did absolutely nothing wrong in their entire lives. Martin is 71 years old. Carol is 68. They live outside of Phoenix, Arizona. Martin spent 39 years as a regional manager for a paper distribution company. Carol was a registered nurse for 3 decades. They are not rich. They are comfortable. And last October, they decided to replace Carol's car in cash so they could avoid financing charges. They negotiated the price down to $40,600 out the door, and Martin drove to his branch of the bank the next morning to withdraw the money. He handed the teller his withdrawal slip. He sat down to wait, and then a branch manager came out and asked Martin to step into a private office. The manager asked Martin why he needed $40,000 in cash. The manager asked Martin if anyone had instructed him to make this withdrawal. The manager asked Martin if he had received any recent phone calls, emails, or text messages asking him to send money. The manager asked Martin if he had met anyone new on the internet. Martin, a perfectly competent 71-year-old man with no cognitive impairment whatsoever, was being interrogated by his own bank about buying his wife a car. And when Martin finally convinced the manager that the dealership was legitimate, the manager told him the withdrawal would be delayed by 72 hours. Martin had to drive back to the dealership and beg them to hold the car for 3 days. When Martin finally got the cash, he thought that was the end of it. It was not. Within 30 days, Martin received a letter telling him a suspicious activity report, or SAR, had been filed on his withdrawal with the Financial Crimes Enforcement Network. That report now sits in a federal database for 5 years, cross-referenced against every future transaction Martin and Carol ever make. Martin did nothing wrong. Martin is a retired paper salesman who wanted to buy his wife a car. And that is exactly what the new rules are doing to ordinary American retirees every single day. To understand why this is happening now, you have to understand the number that has not changed, because that frozen number is the root of the entire problem. The $10,000 bank reporting threshold was written into the Bank Secrecy Act of 1970. That is not a typo. 1970. A gallon of gas cost 36 cents. The median price of a new home was $23,000. $10,000 in cash would buy you 2 brand new Cadillacs. It was more than most Americans made in a full year of working. 55 years later, that threshold has never been adjusted for inflation, not once. $10,000 in 1970 adjusted for cumulative inflation is equivalent to roughly $81,000 today. If Congress had simply indexed the threshold the way they index Social Security benefits and income tax brackets, you would be able to withdraw $80,000 without triggering a single report. Instead, the threshold has been frozen in amber for over half a century, while the normal everyday transactions of a normal retiree have grown 3, 4, 5 times larger in real dollars. A knee replacement, a kitchen remodel, a used car, a down payment for a grandchild, an insurance payout, a lump sum pension rollover. All of them now routinely cross $10,000 many times per year, which means that in 1970, the $10,000 rule caught drug traffickers. In 2026, the $10,000 rule catches your grandmother. That is the baseline. Now, let me walk you through the 5 specific ways that the rules around that frozen threshold have gotten dramatically more punishing in just the last 2 years. Change number 1, the senior withdrawal freeze. This is the change that caught Martin and Carol, and it is the change that almost no retiree knows exists. In 2024, the Financial Crimes Enforcement Network, which is the federal agency that oversees the Bank Secrecy Act, issued updated guidance to banks on how they are expected to detect and prevent elder financial exploitation. That guidance, combined with updated regulation best interest rules from the Securities and Exchange Commission, effectively gave banks the authority and, in many cases, the requirement to delay withdrawals from senior accounts for up to 72 hours if the bank has a reasonable suspicion that the senior customer may be the victim of financial exploitation. Let me explain what a reasonable suspicion looks like to a bank's compliance software, because it is not what you think it is. It is not a suspicious phone call. It is not a fraudulent email. It is any withdrawal pattern that deviates from your historical norm. If you have spent the last 10 years withdrawing $300 a week and this week you walk in and ask for $10,000, the software flags you. It does not know why you need the money. It does not care. It flags you, and a human review begins. That human review can take anywhere from a few hours to a full 72-hour banking cycle. During that time, your money is not released, regardless of what you need it for, regardless of whether a surgery is scheduled, regardless of whether a car is being held, regardless of whether a contractor is waiting to begin work on your home. More than 37 states have now passed their own versions of senior safe banking laws that grant banks legal immunity when they delay transactions that they suspect may be linked to elder exploitation. That immunity is the key because it eliminates the legal risk for the bank of freezing your money while creating zero consequences for the bank if they are wrong. A bank that delays your withdrawal incorrectly pays no price. A bank that releases your withdrawal to an actual fraudster gets sued. The economic incentive is entirely one-directional. Freeze first, apologize later. And here is the detail that almost nobody knows. If your bank delays your withdrawal under this guidance, they are not required to tell you that is what is happening. They can tell you there is a processing issue. They can tell you there is a compliance review. They can tell you absolutely nothing. And you have no legal right to immediate access to your own money during that window. Change number 2, the structuring trap. This one is the most dangerous change because it carries actual federal prison time, and the rules have quietly expanded in ways that now catch behavior that almost every retiree considers to be just smart money management. Under Title 31, United States Code, Section 5324, it is a federal felony to structure your deposits or withdrawals for the purpose of evading the $10,000 reporting requirement. The maximum penalty is 5 years in federal prison, plus forfeiture of the money, plus fines up to $250,000. And here is what most people get wrong. You do not have to be doing anything illegal with the money. The money can be 100% clean. The money can be the proceeds of a home sale, the distribution from an inherited retirement account, the settlement of an insurance claim, or the monthly withdrawal of your own pension check. It does not matter. If the government can prove that you intentionally broke your deposits into amounts under $10,000 for the purpose of avoiding the reporting requirement, you committed a federal crime. For decades, this rule was enforced primarily against deposits or withdrawals in the $9,000 to $9,900 range, where the pattern was obvious. If you walked into your bank 9 days in a row and deposited $9,500 each day, you were going to get charged. Everyone understood that. But in 2024, the pattern detection algorithms that banks use to flag potential structuring were dramatically upgraded, and the threshold at which those algorithms now flag you has dropped significantly. If you are making regular deposits of $7,000, $8,000, or $8,500, and those deposits are spaced in a way that could be interpreted as an attempt to stay under the threshold, you are now being flagged, not prosecuted, flagged. That flag triggers a human review, which can trigger a suspicious activity report, which goes into the same FinCEN database that caught Martin, which can then trigger an Internal Revenue Service Criminal Investigation Division referral, which can then trigger a civil asset forfeiture action against your bank account. Let me tell you about the real people this has happened to. A public interest law firm called the Institute for Justice has documented dozens of American citizens who had their bank accounts seized under structuring rules even though they were never charged with a crime. One family grocery store on Long Island had $446,000 seized by the IRS because the owners made deposits just under $10,000 to stay within their insurance policy's on-premises cash limit. They never committed a crime. It took years of litigation to get the money back. A dairy farmer in Maryland had his entire operating account seized for the same reason. A convenience store operator in Iowa lost $32,000 overnight. None of these people were ever charged with a criminal offense. The money was taken through a civil forfeiture process that does not require a criminal conviction at all. These are not criminals. These are working Americans whose legal deposit patterns matched an algorithm. And with the 2024 enforcement expansion, ordinary retirees who are simply managing their money conservatively are now getting caught in the same net. Change number 3. Crypto, Zelle, Venmo, and Cash App are now inside the same reporting pipeline as your bank account. For decades, there was a clean legal line between traditional banking and peer-to-peer digital transactions. That line is gone. Beginning in tax year 2025, every major cryptocurrency exchange in the United States is required to file a new form called Form 1099-DA, which reports every customer transaction directly to the Internal Revenue Service. Any single crypto transaction of $10,000 or more is now subject to the same Bank Secrecy Act reporting that applies to cash at a bank. At the same time, the reporting thresholds for Zelle, Venmo, Cash App, and PayPal have been dropping every single year. In 2023, the threshold was $20,000. In 2024, it dropped to $5,000. In 2025, it dropped to $12,500. In 2026, it is scheduled to drop to $600. $600. That means when your church sends you $600 through Zelle to reimburse you for catering a funeral reception, when your neighbor Venmos you $700 for the kayak you sold them, when your grandchildren Cash App you $800 to cover your birthday dinner, any of it in isolation or in combination now triggers a Form 1099-K that the Internal Revenue Service expects to see on your return. And a Zelle transfer of $12,000 to your child for a down payment goes into the exact same FinCEN database as walking $12,000 in cash into a bank. Same report, same database, same 5-year retention period. Change number 4, Form 8300 penalties just exploded. Form 8300 is the report any business has to file with the Internal Revenue Service anytime they receive more than $10,000 in cash, cashier's checks, or money orders from a single customer. That covers car dealers, boat dealers, attorneys, contractors, jewelers, real estate professionals. And now, under new guidance, crypto businesses and digital payment platforms. Electronic filing is now mandatory for almost every business that must file. And the per-filing penalty for late or incorrect filings was raised to $290 per return. The penalty for intentional disregard was raised to $3,640 per return. Those penalties fall on the business that receives the money from you, which means every business you pay now has an overwhelming incentive to file the form accurately on time every single time on you. So, when you pay a contractor $12,000 to fix your roof, that contractor is required to file Form 8300 identifying you, your social security number, your address, and the nature of the transaction. Buy a used car from a dealer for $15,000 in cash. They file it. Pay an attorney a $20,000 retainer with a cashier's check. The attorney files it. The form goes directly to the Internal Revenue Service, and into the same database, tracking your bank transactions. And here is the wrinkle that catches people. Related transactions get aggregated. If you pay the contractor $6,000 today and $6,000 next week for the same roof, that is one transaction of $12,000, and the contractor is still required to file. Retirees who break a payment into pieces, thinking they are avoiding a federal report, are actually creating a structuring problem for themselves without realizing it. Change number 5, the inflation cascade. This is the underlying reason everything I just covered hits ordinary retirees so much harder today than ever before. It is not a legislative change. It is a mathematical change that has compounded over 55 years and finally reached the breaking point. Think about what a normal retiree does in a normal year. A down payment on a car, a kitchen renovation, a knee replacement that insurance did not fully cover, a lump sum distribution from a late spouse's 401k, the proceeds from selling a second home, maturing savings bonds, a wedding gift to a grandchild, a mortgage payoff, an amended return refund from the IRS. Every single one of those routinely crosses $10,000 in today's dollars, which means every single one of those transactions now triggers a report, a freeze, a review, or a filing that would not have applied to the same transaction in real dollar terms, even 20 years ago. The average American retiree is tripping federal reporting requirements 3, 4, 5, sometimes 10 times a year, and almost none of them know it is happening. Those are the 5 changes. Now here's what to do about them. Because the purpose of this video is not to scare you. It is to give you the exact protection moves you can put in place this week. Protection move number 1, pre-notify your bank before any large transaction. This is the single highest leverage move, and it is free. Before any withdrawal, deposit, or transfer of $8,000 or more, call your branch manager directly. Explain what the transaction is for and ask them to note it in your customer file in advance. When the transaction hits the compliance software, the note is right there. The 72-hour freeze almost never happens when you have pre-notified. The report over $10,000 still gets filed automatically, but your money actually moves when you need it to. Protection move number 2, stop accidentally structuring. If you need to move $12,000, do not break it into 2 separate $6,000 transactions. Either move it as one single $12,000 transaction, which triggers a report you will never see or feel, or space the payments out with a clear business purpose that has nothing to do with the threshold. The worst thing you can do is break a payment into smaller pieces to avoid a report, because that is the exact pattern the algorithm is built to catch. And remember, even if you are innocent, asset forfeiture is civil, not criminal. Which means the government does not have to prove you committed a crime to take your money. You have to prove you did not. Protection move number 3, move large transactions through a wire, not cash. Every reporting threshold in the Bank Secrecy Act was built around physical cash. Wire transfers run through a different system with different thresholds and far fewer false positive flags on senior accounts. If you are moving $50,000 to a car dealer, ask them if you can wire it directly. Most dealers prefer it. Some will even give you a discount because it eliminates their cash handling costs and their Form 8300 filing obligation. Protection move number 4, separate your digital payment accounts by purpose. If you use one Venmo or Zelle account for personal reimbursements with family and also for occasional small side income like selling hobby items, the aggregate will absolutely cross the $600 threshold and trigger a Form 1099-K. Open a second account. Keep personal in one and any business or quasi-business activity in the other. This alone can save hours of sorting at tax time and prevent the wrong total from getting reported to the IRS. Protection move number 5, build a documentation habit before you need it. For every transaction over $5,000, write down the date, the amount, the source of the funds, the recipient, and the purpose. A notebook is enough. A spreadsheet is better. Almost every structuring and forfeiture case that caught an innocent retiree turned on whether they could produce contemporaneous documentation of why their transaction pattern looked the way it did. If you can show a clean record, you have a complete defense. If you cannot, you are relying on a federal reviewer to take your word for it. Now, before I wrap up, there is one bonus move that I want to share with you because this one is the most advanced technique in this video and almost nobody is using it. I call it the Senior Safe Banking Authorization, and it is a document that you can create with your bank right now that will prevent almost all of the senior withdrawal freezes I described earlier in this video. The Senior Safe Banking Authorization is a formal written agreement between you and your bank that identifies in advance the types of transactions that are consistent with your normal financial pattern. Identifies a trusted contact who the bank can call before delaying any transaction, and pre-authorizes a set of common transaction types: car purchases, medical expenses, family gifts, home improvements, and similar everyday retirement activities as pre-cleared under the bank's elder fraud review protocols. Most banks do not advertise this option. You have to ask for it specifically. When you do, you will typically be directed to the bank's Senior Customer Services Department or the Wealth Management Group. The form itself is short. The clearance it gives you is significant because once the authorization is in place, the bank's compliance software reviews your transaction against the authorized categories first before it ever triggers the 72-hour freeze. A transaction that would have been held for 3 days under the default process gets released the same day under the authorization. This is the move that Martin and Carol did not have in place when they tried to buy Carol's car. And it is the move that, once they put it in place after their incident, has allowed them to make 4 additional large transactions over the last 12 months without a single delay. Now, I want to tell you about something that my team has been working on for exactly the kind of retiree who just watched this entire video. We have assembled everything I just covered and several additional topics into a single comprehensive checklist called the 2026 Retiree Protection Checklist. The checklist covers the 5 bank rule changes in this video, the 7 most commonly missed deductions that retirees lose every year, the 4 estate planning mistakes that cost the average American family over $100,000 in avoidable taxes, the 9 Social Security and Medicare timing decisions that most people get wrong, and the complete step-by-step protocol for putting the Senior Safe Banking Authorization in place with every major American bank. It is 42 pages. It is completely free. It is not a teaser, and it is not a sales pitch. To get the checklist sent directly to you, just go to theasguide.com, enter your email, and it will be in your inbox within a few minutes. And while we are talking about protecting yourself, if you are going to be filing your own taxes this year, or if you are working with someone who charges you far too much for a straightforward return, I want you to look at TaxSlayer. TaxSlayer is the software that I personally recommend to my clients who are comfortable filing on their own. It is less expensive than the major competitors you have heard of. It handles every situation a retiree is going to face, including Social Security income, pension distributions, required minimum distributions, capital gains, and the reporting requirements that come with the new 1099-K rules. And it is backed by a team of tax professionals you can actually reach on the phone if you get stuck. The link is in the description below this video, and using that link helps support this channel at no additional cost to you. Let me close with the most important point in this entire video. The $10,000 bank rule is not getting simpler. It is not getting more senior-friendly. It is not getting adjusted for inflation. It is getting harder, broader, faster, and cheaper for the federal government to enforce with every passing year. The retiree who does nothing, who does not learn the new rules, who does not pre-notify the bank, who does not document the transactions, and who does not put the Senior Safe Banking Authorization in place, is going to be the retiree who gets frozen, flagged, reported, or worse, at exactly the worst possible moment, the moment they need their money most. This is not a prediction. This is what is already happening to tens of thousands of retirees every single year right now, quietly, without news coverage, without any senator giving a speech about it, without any advocacy group running a campaign. It is just happening transaction by transaction, account by account, family by family. You do not have to be one of those families. You have the information now. You have the protection moves. You have the checklist. The only thing left is to act on it before the next time you need to move a meaningful amount of your own money. If this video was helpful, please hit the like button, because that is the single thing that tells the algorithm to show this to more retirees who need to hear it. Subscribe if you have not already, because next week I am releasing a follow-up on the 3 banks with the strongest senior protection protocols in the country, and the 2 banks you should consider moving away from if you are holding significant cash deposits. And if you know a friend, a sibling, a parent, or a neighbor over the age of 60 who has real money moving through their bank account, send them this video directly. The rules have changed. Almost nobody is telling them. You can be the person who does before the next 72-hour freeze happens to their withdrawal.